Hello and welcome to the Osborne practice assessment number 1 for bookkeeping transactions unit. What we're going to do is I'm going to go through it as a walkthrough and we'll see how we go on. So we have a bit of an explanation at the top here, which is basically saying we're using the five-stage accounting system, and we've got a cash book and petty cash book beaten as part of the double entry bookkeeping. So it's basically the cash book and the petty cash book is being used as both a book of prime entry and as part of the general ledger. We've got a VAT rate of 20%. Okay. We receive a purchase order below and we're trying to complete the following dates. So what we're going to do is we've got a purchase order, we're going to put some things we're going to complete our sales invoice. So we've got a purchase order from our customer, we're going to complete the sales invoice that we send to the customer. So we've got to complete the total figure. So we've got 150 units and we sell them at £1.50, so that's the goods, that's the amount there that we're giving as a total in here. We've then got the discount that we're going to apply, so that's 10% times 0.10%. Okay. It's 10%. Okay, £22.50. So what we actually charge the customer is the price per unit times by the quantities minus the discount. Because we're reducing that amount, we're saying we're giving you 10% off because we're giving you a discount per trade or something. So that's the net figure, £202.50. Right, so that's the goods total amount that we are charging, £202.50. Then we got, that's the amount that we're going to get, but then HM Revenue and Customs comes along and says, yeah, but we want 20% on top of that. So we're going to charge £40.50 of tax that we're going to then get from the customer and we're going to give back to HM Revenue and Customs. And so the actual amount that the customer has to pay is the net figure plus the VAT, so they're having to pay £243. So the amount for the goods that they bought, the £202.50, VAT gets added on and the customer has to pay that amount. We get to keep that, the sales, or we're going to hand that sales figure over to our shareholders. That's what they want to take out of the business. And HM Revenue Customs get the £40.50, and that's what the customer pays over in total. Right, okay. Enter the appropriate amounts into the sales day book. So remember, this is a sales invoice. So we're making a sale to a customer, so we put that in our sales day book. And the date was the 13th of May, wasn't it? 13th of May, 2000X. And the details is going to be the customer name. So the customer name is G Finzi. G Finzi. So that's the account that it's going to go into in the sales ledger. And what we got then? We've got the invoice number that we're going to use to track it, 787923. And the total amount is the total amount including VAT. So that's the amount that we actually they're going to have to pay us. That's what they owe us. We've got VAT of £40.50. That's what we're going to have to pay over to HM Revenue Customs, and we get to keep the £205. That's going to go into the sales account in the general ledger. Our journal would look like sales ledger control account, VAT and sales, and the sales ledger control account would be the whole amount. That's what the customer owes us. VAT is going to be credit £40.50 because that's what we owe HM Revenue Customs, and the sales is what we owe the shareholders, £202.50. So that's how we our journal. A backs payment for £1,982 has been received from Malvern's Fashions, who incorrectly state that this amount is settled in full. So they're saying that they don't owe us anything. Okay, this is their balance on the sales ledger here. So let's see what we think that they should have owed. Let's just work out what this sales ledger account adds up to. So we've got a balance brought forward, a debit of 980, a debit of 1752, a debit of 450, and a debit of 135, and 1650 as a debit as well. So all on the debit sides, we've got all of those. On the credit side, you've got the credit 159, and for a credit note, a payment of 892, so we're going to debit, bank, credit, sales ledger control account, and then sales ledger in the sales ledger account. 220 credit, 120 credit. So the total of our credits is that. So the carried down figure we think should be the debits minus the credits in this case, because the debits were higher. So we think that they owe us that. They actually think that they owe us 1982. And so the difference between the two of them is we think that they owe us an extra £1,665 more. Now what we're going to do is just find out which combination of these three items it says in here. Also, which items? So, which three transactions are still outstanding? Okay, so let's just add them up, shall we? That plus that plus that. That's 1785. So so we've got to get something off that. So that minus that is 1665. So basically, it was those three here. So this one here, 3493, 3510, and this credit note over here. Those three add up to debit 1665 that the supplier doesn't see on their purchase ledger, what they owe us. So it's those bottom three then. Yeah, let's just put a little shape in, and I'll put a big X there or something like that. Okay. So those bottom three. That's that question. Right. Our Strauss Limited has just introduced its customers to a prompt payment discount of 5%. So if they pay within a certain amount of time, so within 10 days, they'll get 5%. Electra receives and pays in within 7 days. So they're going to get this 5% discount. It's no trick here that they did in 11 days or something. We are then going to send them a credit note for the amount to be refunded. Total amount of refund on the credit note is what, including VATs. So we've got to check this thing here. We're going to include VAT. So it's not a net of VAT. Okay, so we've got this £249 and 12 pence. Okay, and 5% of that is £12.45.6. So we're going to round that up. So it'll be £12 and 46 pence, including VAT. If it was net of VAT, what we would have to have done there is so if they said what was the net figure and what was the VAT, we would divide that by 1.2. So that would be the net figure. And what we would have done is we would divide this first one by 1.2, sorry. So divide that by 1.2. And that would have been the original net one. And then we would times that by the 5%. It was £10.38, and the VAT on that would have been 20%, which would have been the £2.08. So that's how just watch that question there, just in case it was like show us the net figure or something like that. And that's the only thing you could really twiddle around with in that question. Okay, the purchase order invoice shown below. Right, so we've got a purchase order from the customer, and we're going to have a sales invoice from the supplier. So the purchase order from the customer James plant to Gabriel Oak, who's the supplier. Right, okay. Compare the details of the two documents and answer the question below. So what we've just got really then is going to have two documents here: purchase order, sales invoice, and we're going to see which ones are wrong. Right, so is the purchase order the same? No, it's different. So the purchase order number is different. So we're going to have a shape in here. And so, incorrect figure on invoice. Okay. Is the product code the same? The product code is 4944. The product code is 4494, so they're different as well. So that's different, incorrect figure on the invoice. Amounts of good orders. They order 10, we send them 20. So that's going to be quantity incorrect. The trade discount, let's have a look at that one. So the trade discount is 20% on the purchase order. The trade discount on the invoice is only at 10%. So that's going to be an incorrect figure on invoice. And then the price quoted, we are quoted £35. We invoice for 30, so that's going to be incorrect as well. And so that would be the price is incorrect. Okay, so it would look like that. Right. Where are we going now then? invoice is shown at the bottom of the page. So the invoice shown at the bottom of the page has been issued by Gabriel Oak Supplies. Record the details in the appropriate day book. Alright, so let's go back to this one here. So we had James Plant, and they're the customer. So from their perspective, it will be purchases. And we got Gabriel Oak, and then the supplier. So from their perspective, this is a sale. Who's doing what? What day book have we got? We're in Gabriel Oak's one. Okay, so we're in Gabriel Oak's thing. So Gabriel Oak is making a sale. So we're going to go for a sale. We're going to be going for sales day book, aren't we? And it's an invoice, a sales invoice. It's not like a credit note. So we're not in sales returns. We're in sales day book land. So we're going to be going name of the cash book. That's going to be sales day book. Okay, and then our details are going to, let's go through our details then. So we've got a date in here, and that's going to be 25th of July. I20X, okay. And then we got some details, haven't we? And that's going to be the details, going to be the customer's name. So it's James Plant Garden Centre. Garden Centre in there. Ooh, okay. And then we got our invoice number, and our invoice number was 787963. And we got our total, which is the total amount that they owe here is 109. Oh, sorry, 108. We got the VAT figure, which is £18, and we got the net, which is 90. So that's what we would have there in that figure there. So we've basically taken the total figure, which is what they owe us, the VAT there, and then we've got this net figure. And just to show what would happen to this sale in the sales day book in here, this would go into the sales ledger control account, the VAT account, and the sales. All of these ones in the general ledger. And what we do is we would post the total amount owing is the debit. That's the asset. That's the amount of that money in that we're going to have in the future coming from our customer. The VAT is going to be the credit, the money going out to HMRC in the future, and the sales is going to be a credit as well, the money that's going into our shareholders in the future, which they'll want back. There's our balance journal there, and then also as well, then this 100 in the sales ledger. Oh, well, actually, just going to our sales ledger, we would have this James Plant account, which would be the debit of the 108. So that's how it would look in our accounting system. Okay, task number 3. Lumino Lighting always checks statements of accounts. So they've got so Lumino Lighting is a purchaser. Lumino, they are the purchaser. They're getting in statements accounts from their suppliers. So their suppliers are sending these statements accounts, and they are checking, and they're checking them because they might contain purchases not yet been received. Okay. We got a statement received from Sparks. Okay, so Sparks is the supplier. So they're making sales, and Lumino is making purchases. Okay, compare the entries in the two documents to see which ones only appear in one. Okay, so we got a statement of account from Sparks to Lumino. So this is the supplier. Okay. And then we've got Sparks's one in. You know, this is going to be quite interesting because what we're going to see then here, aren't we? We need to sort of look at is all right. Okay, so this is quite good because they've only laid out a nice run here. So what we're going to have then is, so here is the purchase ledger from Lumino, right? Okay, and what we'll have really then, let's just do this if we posted what Sparks would have done. So this is Sparks' version of this. So they're saying goods were returned, so that would be a credit of 200. Okay, and what have we got in here then? We've got a goods returned would be a debit of 200 because we would owe them less. Now what I'm going to do here as well is, actually I'll do this from Sparks's land. I'll lay out 3 of them so you can see the whole lot. Let's do Sparks accounts first. So Sparks are saying £200 worth of goods were returned. So that would be credit for Sparks, wouldn't it? £200. We invoiced them £590, so they always, Lumino owes Sparks £590. We sent them 2050 there as well. They return this £195. We send them 1720, and we have 7100. Okay, so that's the Sparks account. That's from Sparks' perspective. That's from Sparks' perspective. Well, it's the opposite way around, isn't it? So in Lumino's, if we've returned £200 worth of goods here, well, that means that we would owe them £200 less. That would be a reduction in our liability, so that would be a debit, so that would be a positive, and it would be on the left hand side there. Okay, and so these are the opposite side. Really. If we bought £590 worth of goods from Sparks, then it would be a credit, wouldn't it? We would owe them the money. 195, so we have a credit of 10,250, a debit of 195, and another credit 1720, 710, 33720. So that's now how it should look. That would look in Lumino's accounts if Lumino's was the same as Sparks. Let's actually see what we've had, what we've got in here. Now let's move this down, see what we've actually got. We've got this 200, and we're missing a bank. We've not seen that. Oh, because that just clears off the balance brought forward. Okay, we've got an invoice of 1250, the amount that we would owe. And we would also have a 1720, but we're missing this, we're missing that, and we're missing that. Okay, so those ones are what we're sitting and missing here really so far. Okay, so that's how he would be looking if we were on that side there. So okay, so those will be the 3 that we're missing. So we now go through. So if we're just going to tick here, we'll be ticking the 590 and the 195 and the 710. So those are what I'm missing from those accounts, and it is just a question of just lining up accounts next to one another. But if you're trying to do that there, I mean, it probably would be more fun if this would have been laid out from a Sparks point of view in their purchase ledger, and that would have been probably a better question really. Might have been a bit harder and been right. So the amount paid will be right. Okay, so the amount paid will be. Let's now have a look at what it would be in Sparks's one here. So in Sparks's one then, so Lumino's one, what we've actually got then is we've got a credit of 11970 and a debit of 200. So in order to pay it off, so we've got our carry down in here. So we would have our carry down in here, which is going to be 11970 minus the 200 to balance it. So that would be our carry down. That would be what we're going to have to pay. So we're going to pay that one off there. So it's going to be, the amount paid is going to be 11770. Now, would we just go and go, well, they told us that what it is there, so let's just pay that? No, we wouldn't. We would always pay whatever was in the purchase ledger, and then, or we would even just not pay at all, really, and just fix it. We would never just go, well, there you go, you've told us what you're going to pay, let's just pay it. We would actually have to fix our purchase ledger and pay it. So what's in our purchase ledger is what we're going to pay, and then we'll sort out the position down the line. So that will be that. Okay, the amounts paid would be that. Here we go. Now, so let's go to part C. Cotswold Stones have supplied Barry Builders and Co. with faulty paving stones. All right, so we're going to have some kind of credit note going on here. They've agreed to issue a credit note, yep, and to provide a refund. Okay, the set out below is an account of Cotswold Stones Limited in the purchase ledger of Barry Builders. Right, so Cotswold, and this is always important when you just sort of set these things out so you're not, because you're going to be trying to, or the examiner's going to try and spin you around in your head there. Though. Cotswold is the is the supplier, so they're making sales. Barry is the purchaser, they're making purchases. Okay. They have issued a credit note. Set up below is so we got in our purchase ledger here of Barry. You've got our purchase ledger for Cotswold Stone. There. Okay. Credit note's not yet been issued. So the credit note here is going to come in. So we've got this amount here. So let's work out what our position is before we got this thing coming in. 2250, 2610, 645. Okay. And then we've got 456, 673. What I'm going to do now as well is I'm going to not put the carried downs in there like it would normally go, because it's just easier to just put them as the difference there. So that's the carry down figure there, and then re-add them up to make sure that they add up. Okay, right. This is then comes in. So you're asked to calculate the amount owing to Cotswold Stones by Barry Builders after the credit note has been issued, and enter it into the purchase ledger of Barry Builders and alright, okay, so we're going to have this credit note in here. So the credit note for Barry Builders from Cotswold Stones in the purchase ledger means that we have to pay them less. So if we reduce our liabilities, we're paying them less. That's going to be a money in item. So we are going to pay them less. So that will be a reduction in a liability, a money in item, a debit, and so we'll be debiting 216 here. So it would be then, so let's just pull this down here. Let's do our pull down, which is 6912. We've got our debit in here. Let's now re-add these up. So our carry down is going to be 6696. That's what we are going to owe. Okay, so that's how it would look. Knows how your workings would look as well. So 6696 is the answer for that one. And what we're doing there really is, the way in which to get that one right is to just make sure you get what is the right position beforehand, who is who in there. Then you're going to put your T accounts in. By making sure you know who is who, then you know what your debits and credits are going to be, because you're working out who's money in and who's money out, and that makes you get it right. Okay, the two invoices on this and the next page offer a prompt payment discount for settlement within a certain period of time indicated on the invoices. So we're going to have a time set out on the invoices. Okay, 2%, 14 days. Okay, the amount that will be paid, if the prompt payment discount is taken, will be, alright, so it's £480 if we don't have the prompt payment discount. We can take off 2%, so we can take off £9.60 if we pay within the, in this case, 14 days. So if we pay within that 14 days, we will owe £40.70. So £470.40. So it'll be that one there. That last one is going to be the answer to the first one. The date by which the amount will have to be paid if the prompt payment discount is taken will be. So we got to go for the so it's within 14 days. So we got we're on the 6th in here of August, so 31 days in August, and we need to add on the 14 days, so that's going to be the 20th of August there, so that'll be the 20th of August. So we'd have to pay by the 20th of August for an invoice like this here in order to be able to get the payment. Right, so let's do the next one. Okay, so we got the terms here, 5% within 7 days, so it's £324, 5% of that. What amount will have to be paid if front payment is taken, so it'll be that minus the discount, £307.80. So the 324 minus the 5% discount. And what's the day, when's going to have to be paid? Well, it's going to be that plus 7 days, so that will be the 16th of August, because we got the invoice at the 9th of August, so it'll be the 16th of August. Yeah. So that's task 3 done. Right, okay, so task number 4. The 3 amounts shown below have to be paid to, have been paid to suppliers and are ready to be entered into the cash book. Oh, exciting! So we got suppliers paid in cash. We got some trade payables. So we paid some suppliers in cash. We got some trade payables that we made. Okay, so we've already had the credit for these ones, and then we're going to pay by buybacks from the bank account. Make your entries into the cash book. Right. So what we got in here is we would be having our. Going to have our details then. So I got our details, and we've got our cash. And what we'll do is I'll show you what's happening really here, because you'll see both of them: VAT, trade payables, and cash purchases. And we can then also see what's going on with our double entry bookkeeping. So we got our details in here. So we got our balance brought forward. So what we can see here in this balance brought forward is that we are using our cash book as part of the general ledger really as well. So it's been used as both a book of prime entry and the general ledger, which is what they said right at the start in the introduction. So we got our, what is it, Alvington supplies. Yeah, so we're going there. That's going to be payment in cash, so patch purchases, 150. VAT that we're going to look to claim back, 30. And the trade and the cash out of the that we're paying in cash, 180. So that's the first one there. Then we've got Halwell. We're paying this by backs. Backs means we're paying it from the bank via backs transfer. You'll see that in bookkeeping controls, Frogmore and Co., which is sort of the introduction to a bank reconciliation. Well, that's when we'll see that. Okay, so we've made those payments there, and they were paid. They will be credit suppliers. So we had them previously as credit suppliers. So we've already done the posting from the purchase day book for those amounts, so that's what we would have there so far. Okay, then we've got some totals here. We've got our totals here. So what's going on here? So what you can see is you've got these two halves here. What's happening in the bank account and what's happening in the rest of the general ledger. So what we've got here is what we're going to do is we're going to go. What we've got cash going out, so it'll be credit cash 180, and we've got bank going out as well. We've got credit bank. In this instance, it would be that one there, 3270. We've got debit our VAT account because we're going to get that back. There's going to be a cash in later on. So debit our VAT account 30. And we're going to go debit our purchase ledger control account in the general ledger and that's going to be 3270. So we debited our purchase ledger control account, and we're going to debit our purchases 150. Okay, so that would be the journal that we posted from this posting in the cash book into the general ledger. Now actually what happens though is this bank bit wouldn't be posted into the other part of the general ledger because this is already in it. This is because it's what they said here is we're going to use this bank thing here, and this cash, we're going to use this one as the actual general ledger account. So that's where it's become a book of prime entry and also as well a ledger on its own, part of the general ledger really. So that would be the journal anyway that we posted in there. You can see how it balances. So we've got our fundamental accounting statement, fundamental accounting equation working as well going on there, and that's how it looks. So what you've got in this cash and bank in here, which in this case would be credits, will be on the other side matched over here by debits. Right, let's now go through into our next bit. The debit side of the cash book shows so let's just, if we start to hear the words cash book and debit side, let's just even set up our T account before we even start. Debit side of a cash book shows a cash balance brought forward at the beginning of the week of 250. Okay, brought forward. A further 412 has been received during the week. Debit bank. Credit probably sales. Use your answers to A to calculate the cash balance. Oh, right, hang on. Debit side of the cash book, showing that. Use the answers to A. Right, so there's our cash book. Right, okay, so here we go. This can be the general ledger then, is it? Right, so we've got our balance brought forward of cash. And then we've got our receipts. Right, and then that's going to give us our total figure there, 662. And we've also got the answer in A over here. What would we post over here, which was our credit of 180. So we made purchases for 150. We had VAT that we had to pay on that as well. So we got this figure here, and that figure goes into the credit side there. That was the journal that we posted there. Okay, so that's going to go into there. So our carried down is going to be 482. Let's make sure that adds up. Yep. So the balance is £482. Okay. And let's start again with another T account if we're talking about debits and credits. And it's just a very good habit to be in, really. Don't ever use dead clicks or pearls or whatever other nonsense somebody else comes up with. It's always money in, money out, and T accounts. Right, the debit side of the cash book shows the total amount banked during the week was, so banked, money in, 5341. Okay, cash in. Okay, using your answers to A, calculate the bank's balance. Use a minus sign if you're calculating if you're basically you're overdrawn this and there's a credit. Right, so we've got the answers to A, and so the answer to A was we had a brought forward of 4720, and we paid out here 2106 and 1164. Okay. Oh, sorry, this is on the credit side, so it wouldn't be brought forward there. It would be a minus there. Sorry, hang on. On the credit side of our cash, I'll just put those in again. So 4720. So we actually opened up with a credit over here. Carry forward there, and we paid out 2106 and 1164, and it looked like that. Okay. So to balance this off, our carried down, or brought down, whatever you want to call it, would be that minus that. Okay. So because that's on the debit side, it means it's a credit. So we got our credits here. Our total credits are, let's just go through here. So our total debits are plus 5341, 5341, and our total that's our total debits, and our total credits are minus 472 minus 2106 minus 1164 minus 7790. So that would be if we were going money in, money out, positive money, negative money in here, though, with positives being our debits, minuses being our credits, and sort of the way that you see in an electronic accounting system. And so it would be minus 2694 would be our balance, minus 2694. See in there in our T account in here. And to show you a bit easier, delete that one out there, and then just sort of have that, minus 2694. So minus 2694 is the answer for that one there, though, overdrawn. Okay, now the reason why this was a little bit tricky here was, you can see we opened up here with, on the credit side, so we actually also had as well, if we sort of had our cash book here, this would be the credit side here. We would also have a whole debit side lurking in here as well. So what they've done here, which is the only sort of tricky question I think we've seen so far really, is that they opened up with the credit side of the cash book or the bank account, said it was part of the general ledger, put in the balance brought forward in here, and basically said that the balance brought forward was a credit on the bank account there, sliding that into there. It's not giving us any options. It would have been quite fun if there would have been some options which would have sort of shown that as a debit. Right, okay, task number, let's just check that's all of task 5. Yeah, that's all of task 4. Let's go on to task 5. Right, 2 petty cash vouchers below are ready to be entered into the partially completed petty cash book. Okay, so we've got some petty cash book here. Okay, complete the petty cash book by entering the transactions into petty cash book below. So we've got entry details. Okay, so we've got these things here. So we've got petty cash voucher in here. We've got some VAT on it, and so we've got the debit side here of our petty cash book, and we've got the credit side here of our petty cash book. Okay, so what we're going to do, let's see whether they right now. What we would have, the way in which a petty cash book is set out is, you can see how it's sort of set out with these sort of standardised ones on the left hand side, money in, basically. So we've got our brought forward here. We've got our £47.80, and we've also got our £77.20. Okay. Oh. Okay. We're going to have our date here. On this credit side here of the petty cash, our petty cash position, which then would have debtors and debits in terms of expenses. Let's have we've got our date in here. So our first one is going to be the 30th of June, and we'll have the details of what it is. So they go on A4 paper. Paper in there, whatever it would be, so we'll just call it paper, shall we? Then we're going to have an amount. An amount here is the actual amount of lump of cash that went out, so it'll be £24. But then we've got VAT, we've got office expenses, and we've got cleaning. So we're going to have VAT on that, which is going to be £4, and we've got the office expenses of £20 there. Let's do the next one. Oh, and what I'm going to do actually is I'll put that postage stamp one in there as well. I'll put it in a button just below, but I'll have that in here. And what we'll do is we'll be able to see at the end of it why it is that we do it like this particular way. Postage stamps. That one was just £40, and in office expenses, there was no VAT on it. Right. Okay. The other one then is going to be window cleaning. Oh, it's going to be 30th of June. Window cleaning in here, and we've got £10, and there's no VAT on that one, and that one's going to be in the window cleaning column.
and then we're going to have, we're going to work out our balance carried down to balance our figures. So we're going to, because what we're going to do basically is we got this like a T account. Okay, so total this up. That's the cash in. Total this one up. Okay, so we're going to have a balance of a positive balance of cash left. So we need to balance this up. We're going to have a carried down figure of £125 minus these ones. So that's our carried down figure, giving us our totals in our petty cash. Now, the reason why we put these totals in here like this is because we're going to post this to our general ledger. So what we're going to post is we'll be going it'll be petty cash debit the petty cash one, £77.20, and there'll be a credit the bank, £77.20. That's where this money coming in here. Then what we're going to be doing is we're going to be going credit the cash position, this total here, yeah, like that, yeah, £74. So it'll be credit £74, and then there'll be debit the VAT, because we're going to want that back, £4. This one over here, debit the office expense, and debit the cleaning. Debit the office expense £60 and debit the cleaning £10. That will be our journals that will be posted if we were looking at this then. That's what we laid them out like that. Now actually in reality in a petty cash book we sort of would usually drop that in underneath there. We wouldn't actually put it in there because it's easier to do the journals. So it typically drops in underneath there though, in reality. But the reason why we do this, we're not going to have one for this sort of paper and one for pens and whatever. So these descriptions in here, we sort of put into these columns and straight to just make it easier. These two items here just then became the one journal when we were posting it. So that's why it's laid out like that. But basically we've got this debit side for the petty cash book on the one side, credit side on the other side. We then look at that one. Have we got £51 left in our petty cash tin, or has somebody gone off and robbed it? So that's really what we would have. So what would be the cash withdrawn to get back to £125? So we've got our carry down position. So what we've got at the moment, we've got £51. And we need to get to £125. So the cash that we have to withdraw from the bank to get it back up is £74. So that would be the answer to that one. Because basically what we're saying is the person who's controlling petty cash always has to have £125 in it. In case there's a flurry of people coming in and wanting petty cash, we sort of set it in a position that's not too high so we don't get robbed. But at the same time, it's got to be a reasonable amount, otherwise people come in and asking for petty cash and we haven't got it available. And they get a little bit upset. So that's our task number 5 done. Right, task number 6. Okay, these are the totals of the discounts allowed daybook at the end of the month. So we've allowed some discounts and we've got a discounts allowed thing. So what we're going to do then is we're going to allow discounts. So what is a discount allowed then? Well, we made some sales and we allow a discount. So we're sort of reducing our sales. If sales is a credit, then just get set for the idea that this is going to be a debit. Okay, so what are the entries in the general ledger? So we discount. So if we open up with we discount this thing. So we're going to go debit. Where are we? We're debiting our discounts allowed. So what I'll probably do is I'll do the easy one first, because we'll do the debit the VAT. It's always easier to sort of explain it if I do the easiest bit first. I'm going to credit our sales ledger control account.
So let's imagine that we did this and that we had a 100% discount allowed. So initially we would have gone sales of £384, let's say. So we would have gone credit sales 384, and of that then, sorry, it's credit sales 384. We've gone £384 on the sales, sorry, and we've gone. So that would be it wouldn't be 384, it will be net of VAT. So divide that by 1.2. So our credit sales 320. That would be our net sales position. We would have owed HMRC 20% of that. So we owe them £64, and our customer will be paying us in sales ledger control account. Our customer will be paying us in that £384, because that would be money in. So that's how our initial journal would have worked if this was like 100% discount that we had. So we've sort of said, right, okay then, you owe us £384. We get to keep 320 of it. VAT £64. So actually, what we're doing here in the discount allowed is we're reversing it, aren't we? So we're reversing this round, so that the discounts allowed is going to be the opposite of the sale. Here, so it's going to be debit the discounts allowed, £320. The customer's no longer going to pay us in the £384. They're not paying that. So that's a reduction in our money in item, a reduction in our asset, which is a credit. So credit £384. Then. But we no longer have to pay over to HMRC, Revenue and Customs, the £64. That will be debit. So we got less of a liability, a reduction in our liability, a reduction in our money out item, and so that's a debit because that's a positive money item for the company, isn't it? So it would look like that. There, right. So let's see now what we're going to do here on the basis of that. So, well, that was it. Debit discounts allowed, debit VAT, debit sales ledger control account. Now notice, this is the sales ledger control account, and this is what's in the general ledger. The sales ledger control account is in the general ledger. So in the general ledger, underneath that, within it, is the sales ledger control account. There is also, though, the sales ledger, and that has this breakdown of the customer accounts. And the sales ledger control account is equal to all of those ones added together, or should be if it all adds up correctly. But they're not. They're two different things. This is the posting to the general ledger and is part of double entry bookkeeping, with our debits equal to our credits. This would just be this part over here coming into here. It wouldn't be considering this part. So that's how that's our question there, or our answer there. That one. Right. One of the entries in the discounts allowed daybook is a credit note sent to Modbury Limited for £60 plus VAT. What will be the entry in the sales ledger? Okay, so notice we're seeing the sales ledger here, not the sales ledger control account. That's quite good. I've given an explanation there. Right, so we've got an entry in the discounts allowed. So discounts allowed, and it's going to be a credit note. So what we're going to have then, though, is we're going to have credit the sales ledger control account. And so that was £65. Credit the £65 in the sales ledger control account. We would also have debit discounts allowed and debit the VAT. So the debit the VAT discounts allowed is going to be divided by 1.2, and the VAT is on that is going to be the difference. So it's £10 and entry of that. So that was the VAT there, though, and that's the double entry bookkeeping in the general ledger. This is what would go against the customer's account. So this customer account over here in the sales ledger would go there, so it would just go credit £65. So what we will see then, it will be account name Modbury Limited. It will be the sales ledger. We will have the amount, which will be 65, and it will be a credit because they're no longer going to pay us. So it's a reduction in our our money in item, so that's a negative money item. That's how it would look in the sales ledger. So it's a reduction in our money in item, a negative money in item, and a negative is our credits, and so that's why that would be a 65 credit. Okay, so that's task number 6 done. Task number 7. We're getting a little bit shorter now, aren't they? These are the totals of the cash book at the end of the month. Okay, so we've got some totals here. So we've got our debit side here, and we've got our credit side here. What will be the entries in the general ledger? Okay, so what we've got here then is we've got our figures in here. So we've got some trade receivables in here, and we've got our bank figure there. Then we've got some cash coming in over here, and we've got some payables and some purchases. Right, okay, so let's knock on the head then, first of all, our cash purchases here. So we've got going out and no payments for our cash purchases. We've got cash purchases. It's an expense. An expense then is a loss for the shareholders. Means that we as the company don't have to pay them as much. So it's a reduction in the money item, which is a positive item, so expenses are debits. The VAT, we're going to get that back from HM Revenue and Customs, so they're going to pay their VAT, and then we're going to get that back, so that's going to be a debit as well. Okay, so that gives us this thing here, this cash purchase. Right. So then we have then our trade payables. So we are going with our trade payables, and now we've paid them our trade payables. So we paid those out, so that was a reduction in our money out item in future. So we paid it already out. So instead of a reduction in our money out item is a positive money item in there, which is a debit 101905. So that's going to be our debit for that. But similarly, the trade receivables, we've now received that money, so we've gone debit bank, credit trade receivables, because it's a reduction in our money in item. A reduction in the money item is a minus figure, which is a negative, which is a credit. So we're going to go trade receivables, and that's going to be a credit. 270. Okay, like that. Right, and those are our postings to the general ledger. Now what we've seen here as well is initially right at the start we were told that the cash book is used in the general ledger, so it's part of it on its own. So you'll notice that, see how this doesn't add up? The same, and the difference between it that figure there will be the difference when we got a brought forward and a carried forward, the reduction in the bank in this thing, which is sort of kept separate to the general ledger. This is the reason why nobody actually ever does this. This actual approach, which is sort of set out in AAT, is never done in reality. It's never been done for at least 25 years. I've never even saw it when I was auditing. So it's never been done like that, because you can see how it's messy and it's not really this sort of thing, just doesn't add up. But we'll live in AAT land, and I'll have a little rant here about the total pointlessness of it, because it doesn't work. We all now are in electronic systems, and a trial balance wouldn't balance if we did it like this. It just isn't done like this. So that's that, but that's how it's going to look. Those are our postings to our general ledger, and what we're then going to have really here is this cash book, which is not part of the general ledger, but really is, because we need it for the trial balance. Right, okay. Task number 8 then. The following two accounts in the general ledger at the close of 30th September. So we've got our loans from the bank here. So we've got our credit, our money out item, our liabilities to non-shareholders, our liabilities. Loans from the bank here, this figure here, and we've got motor vehicles. Right, now, would be called a fixed asset in the entire world. AAT will call it a non-current asset in here. So this is an asset because we're going to use it, money item, we're going to use it to make money in the future, an asset, and then money and item, positive debits. Right, what will the balance brought down at the 1st of October on each account? Right, okay, well let's just have them there. Put our T accounts in. Here's our loans. And so we've got our debit 1340, so we paid that off there. We had a brought down loan figure, the amount that we owed at the start of the period in there. Now, right, they've taken out another loan for that there. And to make this balance, then we're going to have to go, that's going to be a carried down. Or alternatively, what we're saying here is our carried forward. Notice how suddenly there's carried down, brought down, the same. So brought down, brought forward, the same thing. Sometimes you might see me go B / FWD, which is the old school method of doing it. So we've got the balance on our loan account in here. So that's going to be a credit of that amount because that's the difference. These figures here minus that. Let's just do the easiest way of doing this. Let's go minus. Let's put these in the way in which it would look in an electronic system. So there's the minus figures, there's the credits there though, and let's go there. And the total then would be that plus that, so minus 24855. A minus would be a credit, and that's actually how it would look in a trial balance in an electronic system. So that's how it would look in an electronic system. In a manual system, it's going to look like that with this thing here, and that's basically a credit. So we've got a credit of 24855, and then let's do the next one, the motor vehicles one. Okay, so balance brought forward. The value of the asset at the start of the period is going to be that. We're going to have a journal, and this journal, the credit, the reduction is the reduction in value is the depreciation charge for the year. Then we've gone out and we bought another motor vehicle, it seems. So we've gone credit bank, debit motor vehicles, and so we're just going to put that in there, and our carry down is going to be there's our carry down, yeah, carry forward or whatever we want to call it in this one. Balance it off. Okay, so that would be debit then. So the value of that is the debit. So let me just do this in an electronic version here. So it's going to be positive of that and a negative of that. That's how it would look in an electronic version of this. It should look like that. Positive plus money in item 22030, so debit. So this one here is going to be the balance at the 31st of October is going to be 24855, and it's going to be a credit. And this one's going to be 22030, and that's going to be a debit. Okay. The following account is in the purchase ledger at the close of day on the 30th of September. Okay. So it's a purchase ledger account here. Complete the transaction by inserting the carried down figure with the date and details, inserting the totals. Okay, so we're going to basically complete this in here. And then, okay, so what we're going to do is we're just going to create or complete our account. Right, so we open up with in our purchase ledger. So the amount that we owe at the start, 3241, our credit figure. We've got an invoice to us, so we've gone and bought something 31468. We make a payment, a credit bank. Debit the Thomas Thompson account. Well, actually, we debit the purchase ledger control account, and we also, at the same time, we debit this thing in the purchase ledger. And we've got a credit note where we've sent something back. Yeah, so that's where we are so far. This side's the highest side in here, so we'll add that up there. And so our carried forward is what we're saying here. Carried forward is what they're using here. It's going to be that minus that minus that. Okay, our date's going to be at the end of the month, so we're going to go 30th of September. We're then going to put our totals in, like that, and we add this up. Okay, so that gives us our total, and then we're going to put our thing going forward. So it's going to be the 1st of October. Oh, let's put an extra column in. 1st of October. Balance brought, and they're using forward, aren't they? So they're using brought forward in here, and it's going to be that figure there. So that's the balance brought forward. Credit, amount owing, money out, negative, whatever you want to call it. No, 4073 is our thing. So that's how that would look there. Okay, So task number 9. Below are 2 general ledger accounts and a partially completed trial balance. Complete the trial balance by, oh, this is an exciting one. We've got trial balance going on. Transferring the 2 balances of the general ledgers to the debit or credit columns of the trial balance. Okay, enter the amounts shown and total both columns. Right, okay. Now this question is the reason why I hate dead click, because you can actually pass this unit without really understanding double entry bookkeeping, but then you will completely fail at the level 3, so never use it. So we got our figures here, okay. We've got our balance carried down, and our sales ledger. So that is the amount that we're owed. Sorry, so now sales ledger control account, brought forward. There. We then have some purchases made. Oh, hang on. Sorry, let's go through here. See what we got here. So we got some sales. Oh no, these are just sales. Sorry, right. Okay then. So we've got some credits of sales going on here. Okay, and we've carried them down into here. Right. So we've got a big credit. Right. So what we're going to do then is we'll open up with what we've got. Right. So sales then is going to be credit. Is the carry down figure there. So there we've got 79085. So let's put that. Let's do it how they're doing it in the question first. So let's do that 79085. Okay. Now sales is an amount that we have to pay over to our shareholders in the future. Okay, so in terms of our fundamental account equation, assets equals liabilities to non-shareholders plus liabilities to shareholders. Assets equals liabilities plus capital. And that is the fundamental account equation, even if you read Osborne and it says something different. What Osborne says is this statement of financial position. So it's money out to shareholders in the future, which is a negative money item, which is credits. So that will be our sales figure. Our purchases here, where's our purchase carry down figure here? Okay, so that is expenses and less money that we have to pay out to those shareholders in future. So those shareholders, they want all the profits of the businesses, but they also have to take the losses. So they want all the sales, but they also have to take off all the purchases. So they pay for that. So that's, for the company's point of view, less money out to the shareholders in future. So a positive money item, positive money items are debits, and so that would be 40029, and that would be on the debit side. 40029. Okay, so that's our opening bit. Now let's just go through the other ones and use the same thing. So administration expenses. So expenses that we can pay our shareholders less money in future. So we're paying them less money in future, so less of a money out item. So that's a positive for us in terms of money. So that's a debit. Loans from the bank. A loan from the bank then though is something we're going to pay them out in future. So it's a money out item to non-shareholders. Liabilities to non-shareholders, a credit. Then we've got office equipment. Office equipment, we're going to use that to make money in the future. A positive item, a money in item. So that's a debit. Asset is your debit. A selling expense, it means that we're going to be paying out less to our shareholders in future. So a reduction in the money item to shareholders, so an expense, which is a debit. Sales ledger control account is money that we're going to get in from our customers in future. So they're going to have to pay that in future. So a future money in item, which is a positive, which is a debit. Purchase ledger control account is a liability to our suppliers. So a money out item in future, a minus, which is a credit. Wages is an expense. We pay that pay out less to our shareholders in future, so a positive money item from the company's point of view. A reduction in our money out item, and there is less positive, and the positive item is a debit. Capital is money that we will have to pay out to our shareholders in future. They want that back. So it's a money out item, so it's a credit. Okay, and that will then hopefully add up. And there we go, it's balances. So if you're struggling with that question really, and this idea, and people often struggle and think that profits are good and therefore good things are debits and therefore it must be a debit, sales must be debits and expenses must be credits. No, from a company's point of view, profits are more money that has to go out to the shareholders. Debits are less money that has to go out to the shareholders, and so that's expenses are debits and sales are credits. Well, that's why if you're struggling with that, make sure that you go and watch that money in, money out item, either with the paper and cups method or just the diagrams that I provide there. You've got to get this nailed down. You can pass this question. This is where you can pass this unit using dead clicks here. You use it though here, you will fail at level 3. You're deliberately set up to fail at level 3, so don't do it. Right, okay, task 10. Business is allocated a supply code to each supplier. So these could be any codes, we'll just have to see what it is. And the purchase ledger. As shown below, the cost is made up of the first 4 letters of the supplier name, okay, followed by the number on the ledger page. Ledger page is set out in alphabetical order. So what they've got then is got their ledger page in here, and they must be going A is 1, B is 2, C is 3, etc. 2 new supplier accounts are applied to the purchase ledger, and they need to be applied to a supplier account code. Okay, so we got Wellesley Fasteners, so WLS, and W is the 23rd letter of the alphabet. So we've got Wells 23, and Sanson, so we've got Sans, and what is that? That's an S, going to be 19. Okay, the first bit. Customers have been offered a prompt payment discount within 10 days. Show what 2 actions, we've got 2 actions going on, will be happening if the customer takes the discount. Okay, so record the amounts in the received in the cash book and ledgers. Well, the customer has paid, we're going to have something going on in the ledgers, and that sounds a good plan. Ask the customer to amend the amount of the invoice. Most definitely not. You don't touch those documents there. Even if you've issued one incorrectly, you would leave it there and then you would credit it. Now, reduce the VAT amount on the invoice by the discount percentage. No, again, most definitely not. You don't touch. Now, we've already had that statement in B. We don't touch the invoice. Issue a credit note. So here, yeah, that's correct. We issue a credit note. 2 reasons why. One, it's in 3 reasons really. One, it's a legal document, so it's the invoice. It's got the VAT on. 2, we're segregating our department up. So we cut our department up into who's doing what. So one person posts the cash book, one person raises the sales invoices, and the other one raises any kind of discounts allowed, credit notes. So we can't have them just going around and playing around with their own bits and making a change, because that breaks down our segregation duties. And the third one is to be able to actually track through our financial system what's going on. We don't go back and change invoices because these are actually in the system, so you won't be able to track it through the accounting system. It'd be a bit and a bit of something, rather than just having nice solid numbers that we can just follow through our 5-stage accounting system. Okay, a company that manufactures promotional mugs has the following assets and liabilities. Calculate below the assets and liabilities for the accounting equation and insert the appropriate figures below. Right, so let's do the proper fundamental accounting equation. For those of you who are doing Osborne in there, though, Osborne one's not right here. It's assets equals liabilities. I'm going to say to non-shareholders plus liabilities to shareholders. And so it is assets equals liabilities plus capital. And that's because assets are debits, the liabilities to non-shareholders, the liabilities are credits, and the liabilities to shareholders are credits. And so debits equals credits, and that there. And that is why the fundamental accounting equation is like that. It is not asset minus liability is equal to capital, because that is debits minus a bit of credits is equal to a bit of credits, and that's a mess. That's not accountancy, that's algebra. That should be left to the maths teachers. We are accountants, and we do it like that. That's also as well the BPP and the capital method, and also as well Google it online. You'll see it's the method of the entire world and has been the method for everybody since the 5th century AD, except for Osborne, who decided that they've invented something new. What they actually say in assets minus liabilities equals capital, that's actually the first statement of financial position. So, right, let's get down to business now then, after that little rant over. So let's just now drop our positions into here. So we've got property, and property then is a money in item. So we're going to use that to make money, and that's an asset. That's a positive, and that's a debit. Our computer equipment is £40,000, and that's an asset. We're going to use it to make money in future. Money in item, that's a debit. And inventories is we're going to, a stock that we're going to sell. We're going to use it to make money. It's a money in item. It's a debit.
It's positive for the company. Our bank overdraft is our money that we owe, a liability to non-shareholders, a money out item, a negative, a credit. Our trade payables is the amount that we're going to pay out to customers in future. Our non-shareholders, so a liability to our non-shareholders, a money out item, a negative, a credit. And our trade receivables is money we're going to get in from our customers in future, a money in item, a positive, a debit. 21,710. Okay, so that is how that looks. 24,630 of assets, 43,000 of liabilities to non-shareholders, and so the capital then is going to be the 24,000 there minus that, and that's how the fundamental accounting equation would work. Osborne seemed to decide to lay it out incorrectly, this sort of assets minus liabilities to non-shareholders, or minus liabilities, whatever you want to call it, equals capital, to try and just do this question at level 2. The problem is that it leaves your debits and your credit and a bit of the credits on one side of the equation, and your credits a bit of the credits on the other side of the equation, and it really messes everything up at level 2. Sorry, at level 3. And you can really see the difference in students at level 3 that sort of use that method of the fundamental accounting equation compared to the correct one that BPP and Kaplan and the rest of the world uses. Right, so describe the transactions below on the left. So we've got the transactions thing there between capital expenditure and revenue. I must confess, in 25 years of accountancy, nobody's ever used this. It's the most pointless question going. But alright, we'll answer it anyway. So we've got capital income, we've got revenue income in here. So capital income is going to be things on that one, what would be known as the balance sheet. In AAT land, it's known as the statement of financial position. And revenue income and revenue expenditure is what we known as in real life as the profit and loss account, or the income expenditure account, what we know as the statement of financial performance, or how well something's performed in a year. So we're very much about sales and expenditure, these two, and these ones are going to be very much about assets and liabilities. So let's see what's going on here. So sale of the firm's Birmingham office. So we're going to have some kind of revenue, capital revenue. So it's an asset, and we're going to have some capital. So we're going to have some capital income for that one. Then we're going to have the purchase of an office in London. Well, that's going to be some capital expenditure. Oh, where's my little shape gone? That's going to be capital expenditure. We're going to have staff wages. So that's going to be revenue expense. Revenue expenditure. Okay, because this revenue, this relates to a particular year of financial performance. These are assets. They're sort of sitting over time. Let's go for the next one, which is going to be interest received on bank deposits. So interest received, so money in, revenue on bank deposits. And it's going to be revenue income though. We're going to get this because this is money in from a particular period of time. So it's revenue that we get in there. You see, notice how they tried to trick you there, this idea of, let's put bank in there. So we see whether you get dropped into capital. But it's not, it's just the interest that you made in a particular period for the financial performance for a particular period, and that would be a revenue income. Insurance costs is going to be a revenue expenditure. Clients fees received is going to be a revenue income. It's clients fees and received, so fees that we got from our clients. There we go. So that's that. Anything else? That's question 10 then. Okay, or task 10 done, and that's the end of the whole thing. So that's the end of this walkthrough. I suppose really, I don't know, as a unit, I have to be honest with you, it doesn't really sort of provide, I think, have the focus, as much of a focus as required on double entry bookkeeping, really, and the debits and credits and the fundamental account equation. We saw a bit of it going through with the need to get our sort of purchase ledger and sales ledger T accounts right, and really sort of think about our T accounts sometimes in the cash book, but it's a bit muddled really on there. What I would do is you really need to get a high score. You can pass this without really having the fundamentals of double entry bookkeeping, especially when you get this kind of nonsense when you get this sort of assets minus liabilities equals capital, and when you also well get in, I think it was in this one here where people use dead click rather than using it properly.
So you can pass this unit without really having a proper grasp of double entry bookkeeping, but it won't work then at level 3. It'll definitely break down once we start to see suspense accounts. So try and get a good score in this one, but try and also as well make sure you've got a good foundation in using your double entry bookkeeping. Money in, money out with T accounts is always the way to go every day of the week. Right, hopefully that was useful. See you for another one. Bye bye.